So real estate as an asset class is less of a cycle in the thought of it going way up and way down. It's less of that. It's more of a recurring pattern
Mhm,
of growth.
mhm.
Over the long haul, real estate goes up in value because it's a critical need for the individual. It's a critical need for the government for it to work. And so what you see over time is you do not see what a typical market cycle would be. You do not see periods of huge growth, and then you do not see periods of huge loss followed by a recovery. In real estate, it's more of a recurring pattern. It is more of a recurring pattern of relatively small growth percentages.
Mm,
Okay, so it might be 3% growth, 4% growth, maybe 5% growth year over year for home prices. But the kicker is in real estate, you get the benefits of leverage as well. So those 3% growth, 4% growth, which is consistent, gets multiplied because of the benefits of leverage. And so we can pull up a slide here to kind of illustrate the points. But real estate cycles really are different. It's less of a cycle here, right? It's a recurring pattern of growth. What I'm showing you here is from the Federal Reserve Economic Data Branch. It's housing prices for Jacksonville, Florida from 1978 all the way through current day. And so this is what you typically see in real estate: slow, recurring pattern of growth. Now, for all of us who were here in 2008 and investing in 2008, you did have a time when house prices went way up
mhm.
and then house prices went way down.
Yep.
But that is certainly not the norm. That is the aberration, and that was an anomaly.
Got it. There's a big lump in the middle here,
Mhm.
and then it continues to go up, and then there's clearly an accelerated rate at the bottom here, which I'm assuming is post-COVID, kind of have like home prices shot up, right?
Exactly.
If we were to look at something that truly is cyclical, less of a recurring pattern and more of like a buy the dip kind of like cycle mentality, we'd be looking at, also a trend, but there would be just be much more fluctuations of ups and downs in this chart. Is
Mhm.
that what you're saying?
Yes, exactly.
Okay, cool. So let's take a little closer look into this thing, right? You see, because we did see that bump and that way down in 2008. Can you explain that to us and how that doesn't constitute that we are now in a cyclical economy?
Yes, absolutely. So 2008 was an anomaly because real estate caused the Great Recession. And if you look at other recessions, going back on that chart, it actually outlined it was shaded when other recessions happen. Other recessions, real estate values go up. There was only one recession where real estate values went down, and it went back and went down in a large way, which was the Great Recession. And the Great Recession was caused by real estate. And so, we had a lot of loans that were made to people that shouldn't have been getting loans. And when you make loans on real estate and you use leverage, it can be a double-sided coin, right? It can be the other side of leverage is if you start making a ton of loans that you shouldn't be making, that can amplify the negative effects of real estate as well. And so that's what happened in 2008. But there has been an incredible amount of government regulation and banking regulation that has gone in to prevent that sort of thing from happening right now. If we go back to Jag's question right off the bat, hey, can I find a lender that can do all loans in one? She's basically saying, can I make it an easier loan process?
Mhm.
Well, it's a challenge. It's taxing. It is not fun to actually go and get money from a bank right now, which is the way it probably should be.
Yeah.
Right. In 2008, it wasn't that way. So if you can have that lens, that perspective that what happened in 2008 was an anomaly, was not normal, and you can section that out from the rest of the 40 plus years of data that we have for home prices,
Mhm.
then it makes it more clear as to why that's different. That's not normal. And the rest of the data supports this recurring pattern of growth in real estate.
So this chart that we're looking at now, we've looked at this for the last 4 years. We've been updating this chart, right? And you see in a very zoomed in way, you see these little ups and downs, right? Like it's much less. This is essentially monthly, quarterly. What is it? It's like a
Quarterly.
monthly, yeah, it's like a quarterly zoomed in chart of fluctuations, and you do see this pattern, this bubble that arises above a median trend line, right? What is this median trend line here, GC?
So that is taking the home prices and assuming that they increase at 4.8% per year. And the reason that 4.8% is significant is because if you go all the way back since 1982, 40 plus years of data, the average annualized home price appreciation for the Jacksonville market is actually 5% per year. But internally, we actually use 4.8% because we underpromise and overdeliver. So that 4.8% line is saying, well, that's what prices should be at if they continue to appreciate as they have on average for the last 40 years.
Got it. So if we look at the last 23 years that are plotted on this graph here, we see this median trend line that holds true if you look at it through a full, market cycle timeline, right? And we see the Great Recession happen, right? Like we see this idea of what everybody was talking about, a bubble. We see this thing trend up way above it and then come right back down and then go way below this median trend line. And then the rest of the time, it's just been appreciating at the same kind of rate with a little bit of increase over here in 2020. How do we know, GC, that this bubble that we see come over the median trend line is not the same as what we just saw in COVID happen when we just realized that everything accelerated and there was this blip up here?
Well, there's a lot of things that have gone into understanding that where we are today and where we have been for the last few years is not the Great Recession. This is why we came so strong on the show 3 years ago and said we did not see home prices declining when the rest of the world said that they were going to. So there's a lot that goes into that. We'll talk a little bit about months of inventory and some other things. But one thing that you all can look at here right on this graph and know that it was different is look at the percentage that home prices are above that projected line. If you go back to 2006 and 2007, you see that bubble that was formed. Well, I don't have the exact percentage, but we'll just ballpark it here. The median home sales prices right there were about 50% higher than what the projected median home sales price was, right? When you have your actual home price being 50% higher than what it's expected to be, that is a sign of potentially a bubble. And that's what was proven to be true.
Yeah. For those at home that are listening on the podcast, right? Like there is a line, there's a red line going through, like a steady, like 4% red line. And then there's this like ascending line that creates this bubble. And what it shows at the peak of the bubble is essentially, the median home price being somewhere, what would you say? That's like 215,000, something like that.
Yeah.
Somewhere around there, 215,000. And if you look down at this red line, it's pretty simple to see. It's about 150,000, right? So like you're basically like $65,000, $70,000 over the where it should be on the trend line. That's that 50% difference between where it is and where it should be.
Exactly. Well
Got
said.
it. So then when you look across and you see, to the naked eye, the blue line, which represents what the actual median home price is, and the red line, which represents the trend line, right, where it should be, the space from the red line to the blue line in 2022 looks comparable to the space between the red line and the blue line, right? It doesn't look as much, but it looks comparable. But at the end of the day, what we're talking about is a trend line that has the median home sales price at like 305,000 and where it actually is somewhere around 360,000. So like maybe it is a $50,000 difference, but now it's not 50%.
Right.
Now the actual price of what it is not, there's not that big of a variance.
It's a really well stated point that we haven't specifically brought that up on the show. So it's a new nugget. And I'm so glad that we're going a little bit more in depth there because there's a numeric quantifiable way to say, is this a bubble or not? And this actual price over the projected line is one of the tools you can look at. It's one of the tools that we looked at and said, do we see home prices going down, up, sideways? This is one of the tools that are allowed. So, you had maybe 50% above the trend line in 2006 and 7. Maybe you have somewhere around 15%.
Yeah.
Here,
difference.
Right?
Yeah.
Very within the range of
15% at the top of the difference, right? Right now it's cooled back down. It looks maybe like 5%.
Exactly. This also has seasonality that comes into play there. So home prices are higher at different parts of the year. So yeah, feel good about sharing that with the group.
That's good. That's a great insight.